Hello traders! In this video I will present you with a highly successful trading strategy. You can use it on Forex trading but also for crypto trading, stocks, indices, all the markets. There are three reasons why I like this strategy so much. First, as I said, is very successful. Second, we can use this strategy for trend reversal and also as a continuation signal, both on short term and long term. Third, and extremely important, we can achieve a high risk reward ratio, more than 1 to 2, usually 1 to 3. But as we will see in tips and tricks chapter, we can even have 1 to 5 risk reward or more. So let's not waste more time and dive in. The two pillars of this strategy are the falling and the rising wedge pattern and the MACD indicator. So, before we dive into the strategy we'll be discussing today, it's important to make sure we have a solid understanding of these two key components. The rising and falling wedge are strong reversal patterns that form at the end of a trend. Rising edge at the end of an uptrend and falling wedge at the bottom of a downtrend. What is very important to understand is how they form and the logic behind the price action. Considering an uptrend, the main idea to understand is that they signal exhaustion. The trend is still up, but is not have more power left, and although the market is still making new highs, these are very close to each other and the price starts to overlap. This we interpret as an imminence of a reversal. Also, what is very important to remember is that we need 3 touches of resistance of support to consider the pattern complete. This is because the falling or rising wedges are in fact ending diagonals from the Elliot Wave theory. So we need 5 waves for the pattern to be complete. By the way, in the description of this video I will post 2 links for 2 courses of Elliot Wave theory. You can check them from there, and also, as always, use the comment section for questions. I will gladly respond to all of them. Getting back to our strategy, the second tool for this strategy is the MACD indicator. The MACD indicator is a widely used technical indicator that can help traders identify potential trade opportunities. The indicator consists of 3 components: the MACD line, the signal line, and the histogram. The MACD line is calculated by subtracting the 26 period exponential moving average from the 12 period exponential moving average. The signal line is a 9 period exponential moving average of the MACD line, so of the MACD line, not of the price. And the histogram represents the difference between the MACD line and the signal line. So basically when the MACD line crosses above the signal line is considered a bullish signal, indicating that the market may be trending upward. Conversely, when the MACD line crosses below the signal line, is considered a bearish signal, indicating that the market may be trending downward. Another way to use MACD, and this is how we will use it in this strategy, is to look for divergence between the MACD and the price action of the Forex pair, crypto coin indices, etc. A bullish divergence occurs when the asset is making new lows, but the MACD is not confirming those lows. This can be a signal that the downtrend is losing momentum and an uptrend may be emerging. On the other hand, a bearish divergence occurs when the asset is making new highs, but the MACD is not confirming those highs. This can be a signal that the uptrend is losing momentum and the downtrend may be emerging. And now let's see how we combine these two. So first, let's see how we use this strategy as a long-term reversal. On the screen we have the chart for Cardano USD, and as we can see, after this break of support, the price came to confirm this break as a genuine one and continued its descent. However, we can see that from this break we can draw a very nice falling wedge pattern. Before we will put MACD on the screen, let me draw your attention to something. Always remember, not in this strategy, but always remember that you are trading the price, not the indicator. So you use the indicator as a confirmation, but the signal should be from the price. Now let's add MACD. Let me zoom a little bit. So as I said, we have this break, we have this low from MACD, we have a new low, this is a higher low from MACD, a new low, this is a higher low from MACD. The confirmation for a buy trade comes with the break above this resistance level. So not here, of course it would have been a little sooner, but considering the fact that this would have been a fail, no stop loss, and also here we have a little of crossover, another fail. So we wait for the price to give us the signal, and the signal is a break above the trend line. And as we can see, price started to rise, and for falling or rising wedge patterns, the target for the trade is the price where the pattern began. In this case here, we can see also that here is a very important level of support, now resistance. And in Cardano's case, we can see that after this break, considering a stop loss under these lows, let me show you long position. So we have the break, we enter, we target this zone with a stop loss under this low. We have a 1 to 6 risk reward. So as I said in the beginning, this is what I like a lot about this strategy, is the fact that we have a very high risk reward. Now let's see how we trade a correction using this strategy. On the screen we have GBP USD, and as we can see also here we have a rising wedge, so a reversal pattern. Also here we have divergence. We have this high, and this high here is not confirmed by this high from MACD. Of course, the confirmation comes from the price, and a break under this level of support, we set a stop loss above these highs and a take profit in this point. And as we can see, for a correction, we also have a very good risk reward of 1 to more than 1 to 2, 1 to 2.6 in this case. Now let's see how we use this strategy as a continuation signal on a short term. On the screen we have Euro USD. As we can see, we have a very nice uptrend, and after this high, a falling wedge is forming. Let's add MACD. So we see we have this high, a drop, MACD dropped hard, a reversal, MACD reversed, a new drop under this level, MACD is higher than this low, and another drop also higher. So in this case, as always, price gives us the signal, so we have the break above the level of resistance, the falling trend line. And in this case, if we buy here, set a stop loss under this low, and targeting this high, we have more than 1 to 3 risk reward. We will finish with some tips. So first, as I said 3 times already, remember that you trade the price, not the indicator. So don't look that MACD is crossing above or whatever and take the signal. Wait for the price to give the signal. Second, you can enter early. So looking at the chart on the screen, using the strategy, we enter here, we put a stop loss under here and a take profit here. So we have exactly 1 to 2 risk reward, a very good risk reward. But looking at this chart, we can see that the third low has 2 small pin bars. Also, what we can see from this chart is an Euro GBI chart. We can see that this low is very close to this low. So it's a first indication that the market do not have more power to the downside. Also, we see very clear on the third, it's this low, low on MACD, this low, low on MACD but higher, this low, so is a triple divergence. So in this case, using the pin bar, we can enter on the break of the nose of the pin bar, and in this case we have more than 1 to 4 risk reward. Okay, you will say, but Mihai, you said that we need to wait for confirmation above the breaking above the trend line. Of course, but in this case we trade the pin bars from here. So we take the signal from the price action, not from the falling wedge. And also in this case, you can juggle with the trade. So for example, you are entering using the pin bar here with a stop loss here, and first you have the target here, so almost 1 to 2 risk reward. But you see that when it's going toward the target, is also breaking this downtrend line. And what you can do is enter a small position here with a stop loss under this level, and when it's breaking above, you double this position, you put take profit on the target for the falling wedge, and you move stop loss for the second in the opening price of the first trade, and for the first trade you put the stop loss on break even. This way, calculating you, if it's reaching the target, you'll reach a very, very nice risk reward on such a trade. So, in conclusion, as I said, this is a very good strategy, and when you'll get used to it, you'll see very, very good results. But you should keep in mind three things. One, it works very well as a reversal using a daily time frame. Second, it works very good when you are trading a continuation of the trend, but for this you should have a very well established trend. And third, if you are trading this as a correction, so you have a trend on a short term, and you want to take this strategy and trade it for correction, you should know that is not working always, and you should trade a low volume, because as I said, is a correction, you are trading a correction, and always when you trade a correction is very dangerous. So that's it for this strategy. Have a nice day. Bye bye.